Hello, and welcome to our webinar on understanding price charts for the financial markets. Now, today's class is sponsored by CMS Trader, one of the world's leading providers of CFD and Forex trading, as well as cryptocurrency. Now, because CMS Trader is a regulated provider, I'm therefore required to give you a risk warning, so let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. Now, if you want, during class today, if you go to www.cmstrader.com, you can open a demo account, no credit card required, just for a couple simple steps. And just go to CMS Trader, click on the buy or the sell button, and it'll pop up a screen where you put in your username and pick a password, and you'll be able to follow along on their platform and using their advanced charts. Now, there's many reasons to trade with CMS Trader, but first is their simplicity. Their website and their online trading has been set up for ease of use. They offer extensive education, impeccable service, and guaranteed security. You'll also get a multitude of account types. You'll get super fast execution speeds. You'll get free daily market analysis and technical analysis. You get a wide range of instruments to trade, including CFDs for stocks, commodities, and indices, as well as Forex. You can also use their watch, copy, and trade social media trading, where you can watch and talk to their best traders, or not their best traders, but the best traders that are trading on the platform, and copy their trades with one click. And lastly, you can learn how to become an independent trader with CMS Trader. You can use their extensive library of video tutorials, get one-on-one sessions with financial experts, and their wide array of ebooks. Now, today's class is being recorded, and if you wish to see a recorded version of this class, in about 24 hours, you can use the same link used to attend this class, and in a little bit of time down the road, investing.com will have this class all edited, and it will be posted on the investing.com website, and you can locate it under the education tab, and then locate webinars on demand to see this class or all classes we've ever presented up on their website. So let's get started talking about financial charts. But before we do, there's a couple things. First of all, I've set up a download for you. Introduction to Technical Analysis. This is a quite important and valuable ebook, and please make sure you click on the download button because you can only get it during this live class. So download it to whatever device you're watching class with, and then save it and move it later to wherever you need it to be. And it'll go over all the charts and all the things we talk about today, as well as a lot more information about technical analysis and trading. Also during class today, I'm going to pop up some polls. These are like mini surveys. Now, we're not asking any personal information. Nothing is tied back to you. And when I pop one up, which I will do in a second, your screen will turn blue and just click off the appropriate answer. I would appreciate it. All it does is help me give better webinars in the future to understand what you all are interested in, what you all trade, so I can use it for the examples in the future and everything else. So I'm going to pop one up now, and we'll continue on with the webinar while you click off the right answer. So the question is, what do you trade? Just click off the answer. But it is no secret that online trading can be performed more efficiently if you possess the necessary tools. And a good place to start is with charts, because no matter how you're going to trade, whether you're going to look at press releases, whether you're going to look at earnings reports, there's no other way for you to know what price action is doing and where to set your stop loss and take profit points, what the market is actually doing minute to minute, without using financial charts. Now, of course, we have fundamental data or fundamental analysis, technical analysis, as well as quantitative analysis. These are all a number of methods used by Forex traders to predict the movement of currencies. Some traders focus on news and interest rates and economic variables, while others prefer to use charting tools and indicators to guide their decision making. Some will use chart patterns. Some will look at volume. Some will look at momentum. But whatever you're going to do does require you to use a financial chart. And you have to be able to look at charts, understand what they're trying to tell you, and have to know how to use the different types of charts. So however, no matter your trading method, you need to know how to read a chart. There's no escaping it. Luckily, we're going to help you out with that. Plus, I've given you the detailed guide. But you must crawl before you walk. And charting is no different. First, you need to have a good understanding of the basics before you can progress to the advanced stuff. Now, a price chart is simply a graphical depiction of the current and historical price of an asset. And a price chart never can be altered. Once that price is posted or once that time has passed, it's just edged into history. So one price chart to another is not going to have different prices on it. Okay. The price of Apple at 1301 is the price of Apple at 1301 for everybody. Okay. And that price that's put on your chart isn't different for the price put on somebody else's chart. Now, I'll give you a little bit of heads up about charts. Today, charts come with feeds. Okay, this is how they come out to all of the, whether you're a broker, whether you're a news site, whether they come out with data feeds. Data feeds are extremely expensive. So when you're getting free charts, like if you're going on investing.com or Forex Factory or FX Street, or you're going to NetDania, or even if you're using TradingView, if you're using their free charts, they use delayed data. Now, nobody's scamming you. Nobody's trying to outsmart you. If you look carefully, it will tell you that, because the feeds are a lot less expensive when they are delayed. Now, when we're talking about delayed data, we're talking about a couple second delay. Most are about 5 seconds. But the fact is, that's just a delay feeding that price into that free chart. It doesn't change what the price was in reality at 1301. So either you need to use charts from a paid for service or the charts on a broker's platform, because the charts on a broker's platform are pushed out exactly immediately, as well as the price on the platform, because the platform is getting the feeds in just to give you the quotes on buying and selling and trading assets. And then it's just feeding directly into the charts. So please be aware of that. Now, charts typically have several different display modes for displaying price. One method that price can be shown as is called Japanese candlesticks. And I know all of you newbies out there in the audience are saying, oh, I love Japanese candlesticks. That's what I trade with. Well, Japanese candlesticks are one of the oldest charting methods, but was one that was hardly used until recently. Okay, and the demand and growth for Japanese candlesticks has grown with Java and HTML charts, because we no longer have to do this by hand, and these candlesticks are put directly on the charts. Okay. But it's a very complex charting method and a charting system, and you have to learn it. And too many people think these reds and green bodies of candles or candlesticks look pretty, and they trade by the reds and greens, but that's not really what Japanese candlesticks are about. So there are 3 basic types of charts. The first is called a line chart. A line chart is the simplest of charts. It really can't be used for trading because it doesn't have enough information or detail. Line charts are a good way to simplify the display of price. The line chart will show you the closing price in most cases. Now, it used to be, again, before we had, all of this computerized equipment that would give us all this stuff, line charts are always based on the closing price for that time period. So if you're looking at a 1-day chart, it's the end of the day. If you're looking at a 1-hour chart, it's the end of each 1 hour. But today, because everybody wants to make things interesting, we can set our charts to display either the close price or the average price or the open price. It really makes it very confusing. But on the whole, all of us should use the close for just when we're looking at a line chart. And as you can see, a line chart is very basic. At the end of whatever time segment, now for class today, we're using the Euro US dollar 30-minute chart. So that means there's a dot put on the chart at the end of every 30 minutes of trading. And that price is then put a dot on the chart, and those dots are connected to give us a line. So we can see at this time period, the euro is moving in an overall downtrend, but we don't see any detail. Okay. So this is the bare basics. I use a line chart very often when I want to quickly look at the markets to see what's going on, because my brain doesn't have to do any calculation. I can see the euro is going down today. That's all I need to see. But otherwise, it doesn't give us really any information. So a simple line chart draws a line from one closing price to the next, and they're strung together. From here we go to my favorite, which is called the bar chart. Now, this bar chart is exactly the same time period, exactly the same asset as we looked at the line chart. So it's the Euro US dollar 30-minute chart. It has the exact same numbers as the line chart, except the line chart has just the close on it. A bar chart gives us a graphical piece of information of what has taken place in that time frame. So we're looking at a 30-minute chart. So each one of these lines denotes the open, the high, the low, and the close for the last 30 minutes. And what we can see here, different from the line chart, is we can start to see prices that have some commonality. We can see opens or highs. Look at that. We see all of these highs right there. They were exactly the same for each time period. We can see down the road, it came back to that same high. Look at that at 112.06. How many times did that price froze at 112.06? Okay. We can start seeing similarities in price. Here we see a downtrend, but look at all these lows in the downtrend staying right on that trend line. We didn't see this in the line chart. Okay. A bar chart gives us a lot more detail about how price is moving. And again, it is my favorite chart. So each one of those bars denotes an open, a high, a low, and the close for whatever period. So if we're looking at the 30-minute chart, at the beginning period of that 30 minutes, we would put a doohickey to the left. And at the close or the end of that 30-minute, we put a doohickey to the right for that price. We would put a dot at the highest point that price reached in that 30-minute period, and a dot for the lowest price that asset reached during that 30-minute period. And then we would draw them, a line through them to connect them together. So that tells us everything that happened. Now, if we see a step up the ladder from the open to the close, we also know it was a bullish period because the bulls controlled the market because the open was lower than the close. In the reverse case, when the open is higher than the close, we see that is a bearish segment and that the bears controlled the markets. So we're getting a little bit of a story also when we look at these lines on a chart. So let me take you over to a real live chart. And let's take a look at this in reality. So we're looking at the Euro USD, and this is a current live chart for the Euro USD 30-minute time frame in the live markets right now. So as you can see, we're looking at a line chart. Now today, again, and I keep reiterating these new charts, and they're wonderful because back when I started trading over 40 years ago, we did hand charting. It means we sat there with graph paper, putting every dot that we talk about on a chart. So we didn't have the luxury of being able to jump from line charts to bar charts to candlesticks and moving back and forth. We had to figure what we wanted permanently, because you just didn't have the time to do all of that information, and you didn't have the flexibility to make changes. Today, we can go from the line chart, which we're looking at right now, simply click on bar, and it'll convert that whole thing over to a bar chart. And we can see right away not only the most current bar, but the chart also shows the open, the high, the low, and the current close for the current candle that we're in, which is all the information contained in this bar. The only thing we don't see on this bar is a doohickey to the right because it hasn't closed out. The close right now is 162, 116.20, but we haven't had that time segment close out. As soon as it does, it'll put a doohickey to the right and then move on to the next bar. So we can see a lot of information. Now remember, I told you that this chart contains the open, the high, the low, and the close. I'm going to click over to candlesticks. And this is, again, the candlestick chart for a 30-minute time period. And guess what? It's now colorful like a Christmas tree. It was easy to convert to. Our eyes are automatically trying to tell us something about the asset because we're human beings and we can fall into this psychological effects of the reds and the greens. But candlesticks have very little to do with the reds and greens, unfortunately. But they contain the same pieces of information that we had on the bar chart. So the candlestick chart, now we're looking at the Euro US dollar 30-minute candlestick chart, which is exactly like what we looked at in the bar chart and the line chart. Now, the only difference we have in a candlestick chart is this red and green, because what we do for each candlestick, for each time, what time frame we're looking at, we put a line across at the open instead of a doohickey. We put a line across at the close instead of a doohickey. We put a dot at the highest price and a dot at the lowest price. We connect these dots to the lines, and then we connect the lines together. So we have the open, the high, the low, and the close. Exactly what the bar chart had. No different. Okay, except if we step up from the open to the close, this is considered a bullish segment, just like we had in the bar chart, except we color this in with white or green. And that tells us that the segment was bullish. Now, the reason we jump from white and green or red and black is because back again in my 40-year-old timing hand charting, we didn't have colored pen. We weren't using colored pencils. We need to do this quickly. So if the segment was bullish, we didn't color it in. If it was bearish, we used the side of our pencil and colored in that time segment. So those days we used black and white. Today we have computer charting, so we use red and green. But the computer charts, they don't care. You set up what you want, bullish and bearish. You can have orange and gold, purple and pink. As long as you know which one's bullish and which one's bearish, it's completely up to you. So why all the hoopla about Japanese candlesticks? Why isn't everybody using bar charts? Well, there's a lot of value to Japanese candlesticks. Now, although bar charts and line charts were quite popular among Western traders, Japanese candlestick charts and additional patterns were introduced to the Western financial markets in about the 1990s. The popularity of candlestick charts has soared among market analysts over the last few decades because of its highly accurate predictive features. Candlestick charts can play a crucial role in better understanding price action and order flow in the commercial markets. But before you can read a candlestick chart, you must understand the basic structure of one candle. Now, each candlestick accounts for the specific time period, just like in a bar chart, each one of those. Now, we were using a 30-minute time period today. We could be using a 1 hour. We could be using a 15-minute. We could be using a 1 day or 1 week. Setting the time periods and time frames are very personal. They have to fit your trading strategy. But you can use multiple time frames. I have a lot of friends who use and it's a very good thing to use. They use a 1 day chart to figure out where prices are moving, and they use a shorter term period to get their entry and exit points. There are many ways to use multiple time frames, okay, to see and understand the markets a little bit better. Now, with a candlestick chart, we have the opening price, the closing price, the highest, and the lowest. So although the same four values are also found in the bar chart uses a horizontal line on the sides of a vertical line to project the open and close. But a series of candlesticks on a chart can help traders identify the character of the price action more definitively, which helps the decision-making process. So as you can see in this comparison slide, the prices are exactly the same. On the left-hand side, we have the bar chart. On the right-hand side, we have the candlestick chart. It gives us just a better graphical depiction that our eyes can see about price. So one of the best reasons to learn how to read a chart correctly is so that you can apply technical analysis. Now, not every trader believes in using technical analysis, but it can be useful even if it's not your primary method of trading. Technical analysis relies on the price that is on the chart you're using. Most charting systems allow you to add technical analysis tools to overlay on your charts. So we could technically call technical analysis chart analysis because all of technical analysis occurs directly on a chart. We have many different fields of technical analysis, but it's always on a chart. So it's one of the most important reasons we want to learn how to read a chart. But the fact is, ultimately, price action is what makes or what's the controlling factor. So it's actually the price movement on a chart that gives you the entry points and the exit points. The technical analysis just helps you analyze what is happening. But ultimately, no matter what your technical analysis says, the price and the next price is not predictable. You can quantify it, qualitate it, strategize about it. But since it's a whole bunch of human beings making up that market, the only thing that you can see is the current price movement and then adjust your analysis or make your decisions. Now, as we had in class, or as we've been going so far in class, we've been looking at a 30-minute chart. Only because 30 minutes is one of my favorite time frames, but it's got nothing to do with any other reason. So you always want to check the time frame displayed. Many trading systems will use multiple time frames to determine an entry for a trade. For example, a system may use a 4-hour chart and a 30-minute chart to determine the overall tendency of a currency pair by using indicators such as MACD and momentum or support and resistance, and then a 5-minute chart to look at the rise from the temporary dip in to determine the actual entry point. So let me pop up some live charts and let's talk about what I'm trying to explain to you here. So we're looking at a Japanese candlestick chart. Now we're going to go back and look at the price in a 1-hour. Let's go first to a 1-day chart. So now we're looking at a 1-day chart for the euro US dollar. This actually covers all the way back to October of 2017. Because remember, each one of these candlesticks is a full day of trading. So it's a full 24-hour cycle. So we can see overall that the euro is in a basic downtrend. Now we saw that downtrend bottom out around here, and now we're either in a retracement which is going to turn around and complete that downtrend, or we're in a reversal coming back up. But now we understand that the euro has been downtrending since April of this year. Okay, and it's lost from 125.50 all the way down to the lows is 113, which is a lot of pips, and now it's only at a 116. So that tells us something about what is happening with the euro. Now, if we were to change this time frame to a 1 week time frame, now this 1 week gives us a different picture of how the euro is trading. Because when we're looking at it in 1 week, look at that. We saw the euro bottom out a long time ago in 2015. Then it kind of moved in some sideways congestion. Then it picked up some momentum in late 2017 and was in a big rally. Now we can either be in a retracement of that rally or reversing down to the bottom it had earlier. We don't know yet, but we have a different view of the euro by looking at it in a different time frame. If we were to convert this now to a 1 hour time frame, now imagine when we're looking at a 1 day time frame, that's giving us the 24 hours of trading of that euro. So when we drop it back to a 1 day time frame or 1 hour time frame, basically 24 of these candles would equal one of those candles on the 1 day chart. So what we're getting is a finer view of breaking down where the asset is, because we need to understand what's happening with the asset, but we also want to understand its personality, what it's been doing long term. But since we're trading CFDs, which are generally traded in a very short period of time, we're more concerned with its short-term movement. So we could see in a short term, the euro has been steadily moving upward. So in this time frame, I would be trading the euro most likely when it comes down to a bottom or to a support level and trading it long to go up, where if in the other time frames I wasn't. Now, I also need to define an entry point. At what price would I be willing to enter the market? So if I take that chart and bring it down to a half-hour chart, I can see more about what's happening. So what I see is that same asset, but I see that it moved up. Now it's moved down a little bit lower, okay? And I would look to trade when it hits somewhere around that bottom that it hit from the shadow of this candle. Okay? And each time frame just breaks down the previous time frame. Price doesn't change. It never, ever changes. But your view of that price can change greatly. Now, because I prefer bar charts, okay, I get the same view with my bar chart. I don't just get the confusion of the reds and the greens. And when I'm putting lots of stuff on my chart, I like the less stuff. So if you imagine your price chart is like a roadmap. And it will help you get where you're going and understand how to get there better. So to give you another example from my old history, I'm not one for maps. Now we're talking about pre-GPS. Today I do everything on my mobile and use Waze and find everything. Because I like it when somebody talks to me and just tells me turn left, turn right, go where I go. I just put my address in. But the fact is, years ago, we didn't have these choices. Just like we didn't have the choice of all these different types of charts. Now, I was the kind of guy that when I had a meeting across town or didn't know where I was going, I'd call them and ask them for some general directions. And once they were giving me the directions, they'd say to me, where you come from? I said, from the north. They'd give me the general directions to go there. I'd write them on a piece of paper, and I would always have to leave an extra half hour early because I never wanted to be late. And I know I'd be pulling off a filling station after filling station to figure out where I'm going, but I would get there. My business partner those days was an expert at reading maps. And Peter would open up the glove box, pull out the atlas, and he would tell me, go to the second roundabout after the church, take the third exit off the roundabout, go past the filling station, turn right at the grocery store, go up the hill, and turn left and pull in the parking lot. And he would be able to see all of this detail on the charts. I would get confused with all this on the maps. So it really depends on what your personality is and what you like to use and what type of trader you want to be. So charts help traders evaluate market behavior and help them determine where the security will be in the future. To help make sense of the price movement depicted on a chart, traders developed a number of different visual guides to assist them, and these are called indicators. There are hundreds of different types of trading indicators developed to cover every aspect of trading, from trend following to mean reversion. Okay. And these are a lot, and they get very confusing. So I believe, regardless of how you want to trade, what information you want to use, and how much you want to learn, regardless of your strategy, you need to put some basic lines on a chart that will help you understand the markets. And these include the current trend line, because understanding the direction of an asset and understanding its current trend is very important. Now, a trend is similar to, no different in a trend in colors, trend in housing, a trend in the length of women's skirts or the height of their heels. All you're doing is looking at, say, the fashion or the in thing. What is predominant? Well, in trends, we have a choice: uptrends, downtrends, and sideways trends. Okay, that's it. But we also have something called a trend line. And a trend line is one of the few rule-based, non-customizable tools that you have. That means all of us will be drawing a trend line following the same set of rules. And whether you're in London, whether you're in Australia, in Sydney, whether you're sitting in Los Angeles, we're all going to be drawing the same line on the same chart. Well, when we can draw this trend line on appropriately, we can then predict what price will be important to the market, not whether you want to buy or sell. What price should we get a market reaction to? So it's important because it's one of the few rule-based things you'll do that will have the same commonality as everybody else around. So every trader should be able to add these building blocks onto their charts. And I don't call these part of a strategy. I don't call them part of technical analysis. I call it part of your basic knowledge of being able to trade in the markets. You should not be allowed to make a trade unless you understand and use how to put trend lines, understand support and resistance levels, and understand volume. Most platforms should make you draw a trend line on their charts, put the support and resistance line, click on volume before it lets you put on the trade button. Unfortunately, they don't. Because whether you believe that Jeff Bezos is going to come out later today and say something fantastic about Amazon that's going to push Amazon stock through the roof, or Donald Trump's going to attack Facebook, is going to send Facebook soaring, well, that's your decision. And you can make that decision to trade, okay, by a whole bunch of other information. But if you want to do risk-reward analysis and money management, which is more important than any type of strategy you can have, you have to do this with charts, because a chart's about the only place you're going to be able to look at to see, oh, already the markets have pushed that stock up too high because the traders already predicted Jeff Bezos would say that. Or I got the news an hour too late on Trump and Facebook already fell. You're only going to get that from a chart. And if you think that Bezos' statement is going to push Amazon way up, okay, at what point do you want to enter the market? At what point are you willing to exit the market? What point do you want to put your stop loss if that market turns against you? And what would you look at to know that the other traders around the globe also believe that Amazon's going to keep going up based on what Bezos said? Okay. So this comes from the basic building blocks put on a chart. So let's go over to the live charts I had, and let's take a look at this for a second. Okay, so here we have the Euro US dollar chart on a 30-minute chart, and it tells us absolutely nothing. Okay. So you're getting a general look at a chart. But if we were to go put a trend line on the chart, and if we knew how to put it on properly, sorry about that. Okay. We could then start making some sense out of the marketplace. If we were to look at volume, which can be very easily added under charts, and volume tells us the number of contracts or shares being traded. We're now starting to use this chart to make some sense. Look at the increase in volume as the price rallied upward here. Look at the increase in volume here as price is coming back up. Now we see volume's fallen, but the buying volume is relative. So traders are waiting for the price to make a decision. Then if we were to look at some basics, which is what we call support and resistance. Support and resistance are historic prices that the asset has had a problem going through that price or staying above or below that price. And we want to base it on the current price, but we can look back into history and look here at this here. So we would want to put one of our support and resistance levels right there, because we look at how many times that this price has come to that level and had a problem with it, either buyers or sellers. So when we look at that, so we would expect that if price were to move back up to that 162.46, that it would either bounce off of and stay below, like it's been doing, or move above and break through, and that would give us some momentum. We could look for another resistance level, something below the prices, and now we have an area around prices that we can start talking about. Now, if we were to combine that by pulling our trend line out into the future, we then are starting to make some sense out of the asset. We're not making a trading decision. We're just trying to make some sense. All we're trying to do is figure out what is happening. Okay. Now there's simple things with adding on moving averages. Once we have our chart set up, we can add on things like indicators, like a very famous one, relative strength index, which is put on below our chart. Or we can add MACD, which is moving average convergence divergence. Okay. And we're starting to be able to build our trading plan. We can very easily, like I said, convert this back to a candlestick chart. So if you like all the colors of candlesticks, you can use a candlestick chart. And look at that of all the reds and greens. Now, candlesticks have 32 different what's called positions. Because like I said, too many traders think candlesticks are about the reds and greens, and they're not. They're about the relationship to the previous candle and the preceding candle, and the patterns that those candles make, and about the body or the size of the body of the candle. And there's a total of 32 patterns of candles. Okay, 16 are very prominent. And we have dojis, we have marabuzas, we have hanging men and hanging and hammers and evening stars and morning stars and 3 black crows and 3 red soldiers, all different patterns. But if we could use those, we could combine them together to help interpret price. And ultimately, what we're doing is trying to interpret price action on a chart to come up with an edge to make a decision about whether we want to trade an asset to go up or down. Okay. Then we also want to be able to set where we would want to put our stop loss. Now, our stop loss is how much we would be willing to lose or how much we could afford to lose if the asset moved against us. But then we also have to determine what is the daily volatility. How much is the swing of that asset throughout the trading day? So if we can't afford to put our stop loss close enough to cover what we're willing to lose, but far enough that we're not going to get stopped out just from the daily swing of the markets, we shouldn't be making that trade. But you're only going to find that in a chart. Now we can see that the euro US dollar day hasn't been so volatile. So you could probably set your stop loss a lot closer in a less volatile market and protect you from the market moving against you. We could probably find a good trading range between these two support and resistance and trade it if it bounces off that upper support line, trade it to go down, or if it bounces off that resistance line, trade it to go up. But those are just preliminary decisions. But we're starting to make the market make some sense. We're moving away from guesses and moving over to strategy and knowledge and education and making an intelligent market decision. So this is how you would incorporate charts using time frames, chart types, indicators, and some basic lines on a chart. And you don't have to get complicated. You can start out, here's a quite complex chart with gold, okay, which I think has got too much information on it, and you can get lost in the analysis. But if we were to take some of that off the charts, okay, and let's get the Fibonacci levels off of here, okay, we can basically use the volume, the divergence, and the support and resistance lines on the chart to make some sense out of it. You can make it very complex. You can get it all wrapped up however you want to wrap it up and get yourself lost. And too many traders do that. But look at this. Here we have a very simple system. We have one MACD indicator below. We have volume on the chart. We have our trend line drawn on there. We have our resistance level and our support level. And this is all that we're using to predict market direction. So we're looking for when price breaks below that trend line to fall down to its next support level, or to rally off of that and come up to its next resistance line. But we don't know what it's going to do. We're just making some sense and predicting what we think might happen so that we can be prepared to make a trade. And this is what charting is all about, is finding high probability trading opportunities I'm sorry, I forgot to take the poll off of here. There we go. So that you can see the chart. And all we're looking for is an edge in the market to make ourselves a smart decision. So I've tried to explain all that to you in the handout that you have. It's our simple little book on technical analysis, and it will help you give some understanding of time frames, trend lines, chart types, support and resistance, and the use of indicators on a basic level so that you can start. But most of this comes with time and effort and learning. Okay? So don't overcomplicate your life. Don't freak yourself out. Again, think of this as a roadmap. Start out with the roadmap you're comfortable with, that you can read, and then start adding on more information. Maybe you want to add where there's construction work. Maybe you want to mark where the school buses are, or where the school is. Maybe you want to know the time of day that there's heavy traffic in the area. All of that is part of including on your map to success. So once again, thank you very much for joining us today. Now, we do have a class coming up on just one class on candlesticks, so watch for that. Or go over to investing.com and look at one of our previous classes on candlesticks. because I know you all like to trade with candlesticks. And join us for all of our classes, or go to www.cmstrader.com and enroll in any of their future webinars, download their ebooks, or get some help from a one-on-one financial counselor there who will help you understand all of this and make sure that you have the best education possible. So again, go to www.cmstrader.com and set up your demo account and start learning how to use all of this in your basic trading. So thank you very much for joining us, and have a great day. Bye now.